All right, gang. Happy Thursday to you. Welcome to the live trading room, the New York edition. Hope you guys are doing well. Let's hop into the charts. Got a handful of things I'm going to take a look at today. There's still not a massive amount of movement in the market, but we do have some opportunities to check out. Hey. I think we have some issues with the login today, so I think the people will flood in a little bit. Or maybe it's some type of holiday I don't know about again. But let's get started. And we're going to get started with New Zealand dollar today. Now, this is going to be kind of a secondary opportunity because the first opportunity is already moved forward. But what we're looking here at New Zealand dollar was a pullback trade. And it was a pullback trade that turned into a flag like pattern, right? So it's not going to be a technical flag pattern. We don't have the kind of the channeling effect that happens when price moves back and forth between different areas, but you can see the general concept. And if you guys remember yesterday, we were talking about a violation of this level, looking for a pullback into that level, and ultimately a move to this structure level higher. That's going to be that white box up there. If you're on your Ninja Trader charts, you should see a VS1 level up there. Now, for someone who was looking to enter aggressively, right? Well, you would have had to enter after this candle right here. There was no higher high, higher close. Maybe if you go down to a lower time frame, you may have seen something. But in most cases, there was not an opportunity to get involved. And something that's important to understand as a trader is that it's important to, even if you don't have it at first, right? This is kind of the evolution of trading, and as you grow and you develop and you add to your trading plan, it's important to have multiple opportunities or multiple ways to enter the trade. And I think what you'll find along your trading journey is this. At first, when we start off, we want to trade a million things. We want to trade this, we want to trade that. There's 80 billion things that we often want to trade. And then as you get older, you start to condense that list. You really start to pick out and focus on what your best trades are. So maybe you have like 10 setups that you initially like, and then as you get experience, maybe as you go through your back testing, whatever like that, you realize that, hey, 5 of these opportunities are like, they're okay. They're opportunities, but they don't really put me in the most positive position ever. So they end up getting scrapped. Again, a good example was on Tuesday, we spoke about the butterfly pattern, how I like the butterfly pattern. There's certain things I don't like about it, but it was something that the way that I needed to trade it didn't give me a massive amount of frequency. So it ended up being cut from my trading plan and I no longer trade it. And when that happens is you lock in on quote unquote your best trades, your go-to trades, right? Your most productive, your most efficient setups. And then you start thinking about, well, how are there alternate ways, right? Alternative ways that I can enter these setups, because you'll learn really, really quickly in trading that you're going to miss a lot of trades. So you're going to miss a lot of trades sometimes because you fall asleep and you're not there when it happens. The trade setup may happen while you're somewhere else, maybe overnight, or the trade setup may happen where it just doesn't give you an opportunity. Again, if we use the example in front of you, if you're someone that's looking for a higher high, higher close here, if you're eyeballing this and saying, man, once I get a higher high, higher close, or if I get a higher high, higher close, I'm entering right here at market and I'm going to trade this breakout up or get involved in this breakout at the bottom and trade it up. And then the market just didn't give it to you. Well, we have two choices. We can either let that good trading opportunity go forever and just be like, hey, it's gone. Or we can ask ourselves, are there other ways that we can get involved? Are there other ways that we can still look to get involved in our overall prediction, even if it's not at the quote unquote ideal level? So in this opportunity like this, right, there's nothing you can do, right? This move has happened already, right? But the prediction is still valid, right? Nothing has changed about our overall prediction, right? Nothing has changed about the ultimate area in which we look for price to go to. So now the next question is, okay, well, I couldn't get involved here. What do I need to happen now in order to get involved in this move? And what I would need here, speaking just of myself, is I would need a fresh break. We know this is a previous pivot point, a previous kind of structure high where we create a new structure high and then we retreat, retrace, and move back here. We know our rules on reading a price chart, right? We know our IPDE process: identify, predict, decide, execute. So if we put in a higher high, higher close above that level, we can identify a higher high, higher close. It then allows us to continue our prediction that price is likely to go higher. And then we know the prediction part is like a 3-point prediction. Long story short, we're predicting for price to go up here. So the next thing that we're looking for here is a fresh break of that 57.19 area, 57.20s area. And if we can do that, we have room to go up to about 58 even. If you want to be a little bit more precise with this area, we can take a few things here. We can take, well, I'll let you guys answer it. What can we do if we want to be a little bit more precise with our prediction to the upside? This follows up on our Monday Q&A session where we spoke about identifying targets and how we typically start with a broad stroke and then we fill in the details later. Yep, Fibonacci extension is one tool we can use. So take my Fibonacci extension tool from my swing low to my swing high and back down. You're going to see a 127 right there, a little bit lower. There'll be a 1414 in here. I don't really keep it on my chart, but then a 1618 a little bit higher. Equal measure move, AB equals CD, right? So I'll just copy and paste this move right here. Since we do have our retracement right here, and you can see equal measure move is going to put us right in that area as well, right at 58 even. So we don't have necessarily the Fibonacci and AB equals CD pattern influence, but we do have a Fibonacci extension level a little bit lower than our structure level. We do have an AB equals CD right at our structure level and right at our even handled number as well. So making that a good predictive area to be in. So now the decision is, how are you going to enter? Are you going to stay here on the 4 hour? And again, this is going to be all rules based. Do you drop down to the hourly, get a little bit more of a zoomed in view? Obviously, when you go down to the hourly, you're going to get, well, whenever you go down to a lower time frame, you're going to get a quicker signal. You'll also get more false signals, right? This is same thing as when we spoke about the RSI settings yesterday, where, hey, you go down to a lower period RSI, you're going to get more wigglage, you're going to get more overboughts, oversolds, more divergences, but you're going to get more false signals with that. You ramp your indicator up, use a slower RSI, you're going to get less wigglage, less divergences, less overbought and oversold scenarios. Someone just gave me 200 coins. I have no idea what that means, but I know Nico though. Good friends of Nico. So thank you. Money. Appreciate it. King of Harmonics is at it again. Keep it going, Akil. Your streams are much appreciated. Thank you. Thank you. I was talking about you yesterday, Nico. I'm not sure if I guess you are watching because you put this on there. Yeah, we were talking about you yesterday and kind of the patience that you put in, kind of putting in the free hours at TradingView and then finally being rewarded, which is pretty cool. Orsted may have a 3 drives as well. So going back to this initial move right here. So looking for 3 equal length moves in a row. One. Well, this would be 1 right here. Sorry. This would be 2. And this would be 3. Yep. Nice 3 drives pattern up there as well. Very nice. Haven't looked at a 3 drives in a while. Awesome. I wonder if we have symmetry. I don't think we have symmetry in the pullback. Close. So yeah, nice predictive level to get up there. Now what you need to do is you need to game plan. You need to ask yourself what needs to happen. Obviously, first is the higher high, higher close. If I get higher high, higher close, then I wait for pullback. If I get pullback, then do you need price to come to a certain Fibonacci level? Do you need the RSI to do something? Do you need a certain candlestick, right? That's going to be the next part of the process. But the general prediction with this one is pretty simple. Wait for the violation and wait for the continuation higher. Bigger picture, this is an interesting one because if we violate that next level, there's a massive amount of room to the upside here on the Kiwi, right? If we're just looking at this thing right now, I'm going to bring in the volume indicator real quick, but it should line up with where I'm thinking because structure is structure. Yep. Right in here, right? So you see this level. This is our next strong level of structure, right? This little structure swap area right here, we'll make this kind of a zone right here. You can see it's also where the volume kind of picks up a bit as well. Bigger picture, if we can break this level, and I'm going to isolate this again, right? Put it right here about 59, let's say 60 flat. 60 flat. And it looks like is that a 618 or 50%? 50%? Oh, yeah, right at 50%. There we go. Talk to me nice. Look at that. If we can violate this level, we're likely to continue up here. So, and this is the dilemma that you have, right? Because typically with counter trend trades, you're looking for, well, at least me, I can only speak for myself. Typically with counter trend trades, I'm looking for a 1 in, 1 out, right? Trend continuation trades, your trend is your friend. You're with the flow of the water. You can shoot for larger targets because your expectation is that the trend will continue in that direction until it hits a point where it doesn't. Counter trend trading is typically a little bit different. Counter trend trading, you're looking for the relief. So you're looking to play the pullback, and you know the pullback is kind of a short-lived type of thing. You don't necessarily expect the pullback to last forever. You expect the pullback to come and then for markets to reverse and go back in its original direction. But we got an interesting situation here because we are at, if I draw another yellow line and then confuse you, we are at a previous structure low, right? Can you guys see that? Look left, structure leaves clues. Is that pretty obvious? Give me a yes. And this is the interesting thing we were talking about. We had our team meeting the other day about we're going to do a workshop in November, a week-long workshop. And we were talking about our general kind of overview of the market. And it's very interesting that I haven't seen this in a long time, probably since going back to like the recession, the one in like 2008, 9, that one, 10s. We're seeing a lot of currency pairs at like all-time crucial levels. And those levels aren't hit too often, as you can imagine. And I think that's going to offer a lot of opportunity when we start seeing reversals. We're also starting to see a pivot, or we're going to see a pivot in monetary policy after kind of like a year and a half of like aggressive craziness. We're going to start reverting back to kind of being normal at some point. I think it's an interesting time ahead. And so the interesting concept about this is, if you're looking at this as more than a deeper counter trend trade. So not just a normal counter trend trade where, hey, you're looking for a little bit of relief, a little bit of a bump, and I want to get out because the market's going to continue in its direction. If you're looking at this as kind of being like the end of the road, this is the last stop on this bearish New Zealand dollar bus ride, and you're looking to see a greater relief, something very similar to what we saw back here, where we start coming back up and reverting back to kind of our usual area. Again, just to give you kind of some historical kind of views in here, then it may not be a bad idea to hold on for a partial position for that higher retracement. Now, again, that's something that's going to be on you as a trader and your risk appetite. But that is something to consider here. By the way, Zach, just because I was thinking of you, do you see it, Zach? Do you see it, Zach? I know you see it. See it? Is Zach even here? He was here earlier. He's one of the first ones in here. Here we go. Yeah. What do we have down there? Yeah, you got your bullish divergence. We got trapped looking at diversions yesterday. Just kind of got stuck in the muck, just checking out areas of divergence. Yep. So you got your diversions here as well. Doesn't have much to do with kind of the bigger reversal, but the divergence in again in this move already kind of occurred, but just pointing it out because we did speak about it yesterday. So I thought this was a very interesting opportunity on New Zealand dollar because it is that counter trend move that does have the potential for more upside legs. The tough part is it's a counter trend move, and typically you're not looking for quote unquote extended targets with this counter trend move. Another option would be just to wait. We're going to look at a few of these a little bit later today, but a classic pattern that we typically see at the end of directional moves is a head and shoulders pattern, right? So even if you look at this as, I don't want you looking at this as kind of like a FOMO situation where you're like, oh my gosh, well, I like the smaller move that Akil pointed out, but I don't want to involve myself in the bigger move, but I don't want to miss it either. There are typically multiple opportunities to get involved in a trade, which is kind of the theme of today anyway. So don't be surprised if this ends up being a head and shoulders, right? A head and shoulders is a classic reversal pattern that comes at the end of an extended move, right? We may actually do this, come up to wherever our targets are at in this area, right? 58 even, right? Hit that level, retrace back down again, give us some consolidation, either a kind of a sideways crab shuffle consolidation or a head and shoulders pattern before breaking to the upside. So there could always be secondary opportunities where, hey, we just consolidate here and then we finally break and then we just reset the whole process again, right? The same thing we're looking for in this situation. Wait for the break, wait for the pullback, wait for the extension, right? It's the same darn thing. And if you guys are new to my channel, it's interesting. I was talking to Jason yesterday. I think it was in the pre-show before we did our coffee break on Are You Too Old to Trade? But we were talking about, no, I think it was during the show actually. I always get confused because our shows are basically, we don't script them or anything. We just kind of hang around the coffee cup or a coffee pot and talk. But we were talking about longevity in trading, how it's funny that we've lasted as coaches since, I started coaching 2012. I think Jason came on 2014. And how you see us old dinosaurs still here, still coaching. Very little has changed. Now, for you guys that know us on the inside, right behind the curtains, you know that we've evolved a lot as traders. You kind of know the inside changes that happen to our journey. But the general principles and elements of our trading style, our trading philosophy are exactly the same. And it's funny that you see us old dinosaurs still here after, 10 years, 12 years, whatever it may be. And then you see the churn of these other educators out there. And I bring it up because my trading style is pretty simple, right? I predict based on structure. For me personally, I trade based on pullbacks. If you had to break it down into two things, aside from like the advanced pattern formations, and I don't want to oversimplify it, but I predict based on structure. I enter based on pullbacks, right? If you broke my trading down into two simple kind of rules, that would be it. Now, there's a whole process in identifying and pinpointing levels of structure and all that fun stuff, but predict based on structure, enter based on pullbacks, right? And you see a lot of people, oh, that's boring. It's the same and same and same and same and blah, 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 blah. Well, if it works, like, does it have to be complicated? Do we have to overcomplicate trading to feed our ego? Do we need to do a million things just so that we look good? Like, I don't know about you. Like, I don't really care about my ego. I didn't get into this thing to be known as like super trader or the greatest trader of all time or this new trading guru who invented something that no one else has, right? My best friend, he did that. I came into trading to make money. Like, that's my goal. I want to make money. And like any entrepreneur, if I can make money the simplest way possible, why would I make things more complicated? If I can make money in a very simple way, why would I opt to make money in a more complicated way? Like, I want you to ask yourself that question, right? Would you drive the long way to get somewhere? If you need to go to a destination and your GPS gives you two choices, aside from like saving money on tolls, would you take the route that takes you 2 hours or the route that takes you 4 hours? Probably the route that takes you 2 hours, right? If you have a project you need to do around the house, would you take the easy solution, which gets the project done, or would you do the hard solution, which has you do everything else but the project and it takes you double the time? Right? So when I hear this stuff about, oh, it's so simple, it's too simple, I'm like, yeah, like that's how my brain works. I have a simple brain. I have a simple brain. I like doing things in a simple way. And sometimes we have to push that ego to the side. Now, simple doesn't mean you have to have one thing, right? As you saw, we still broke out Fibonacci's. We looked at diversions. We looked at harmonic moves. Like, for many, that is complicated stuff. But the general process of is simple. IPDE, IPDE. Identify, predict, decide, execute. What you value should be simple. And then what you put into that, those are just the little intricacies that kind of make your trading what it is. So cool stuff. Real quick says, YouTuber George say, hey, morning Keel, what is your opinion on a strategy that does good for 2 years and goes break even for 1 year in the third year? Well, I would need to know more information. So what happens in year 4? What happens in year 5? What happens in year 6? So if it goes good for 2 years and then we have break even the third year, but then we go good in year 4 and year 5 and year 6, I'm 100% fine with that. If we go good for 2 years and it goes break even in year 3 and then good in year 4, but then break even in year 5 and break even in year 6, then that's not something I'm too interested in. I would also ask you this: when you say strategy, is this a strategy that encompasses? Is this your only strategy? Is this a single pair? Is this multiple pairs? That makes a difference as well. Me personally, I can't have a break even year trading. So, I trade for a living, so I need to make profit. I guess I could have a break even year trading. I'm not dumb with money, so I can afford to live, but I would prefer not to have a break even year of trading. I need a profitable year of trading. So if this is the only thing I trade and it's break even and I don't have any other sources of income that can pay the bills, then that's not going to work. I need to make some sort of profit. Now, even if it's a lower profit, even if I have a 20% year and I'm used to having 40% years, I still need to make some sort of profit. If this is only a single strategy and I have other strategies, then that makes a difference. So, for example, I'll give you a really good example. This would have been, 2017 with harmonic patterns. So I have a 9-pair portfolio. I trade 9 pairs, harmonic patterns, ciphers, Gartley's, bats. That's one piece of my trading puzzle, right? I have that, and I have price action trading. But we'll just look at harmonic patterns, for example. So 2017, the pound dollar kicked my butt, grabbed me by the hair. I had hair back then, pulled me up, and proceeded to whip me to death all year. Horrible, 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 horrible. In fact, it got to the point where I was considering dumping the pound dollar. I was so frustrated. I didn't want to look at it. It was evil. But the other pairs in my portfolio did well. So the strategy was still profitable. It was just one kind of outlier pair. And that happens from time to time. It'll be the dollar yen or dollar Canada usually, because that's not really a good pair for patterns. But the other pairs, the other 8 pairs made up for that one pair. So that was fine. So in that case, it doesn't really matter if the pound dollar has a break-even year or in that case, a negative year, because I have the other pairs in my portfolio making up for it. So if you're only speaking of a single pair or a single strategy, that could be a problem. But if you diversify, right, if patterns have a poor year, but your price action trading is amazing, then you can survive that not random, but that rare break even and or negative year before you get back to business. So it comes down to, is that negative year or break even year, is that a trend? Or is that just an outlier? Because there's going to be outliers. For anyone that's ever tested before, you know how it is, right? You may test for 10 years and you may have like the first 3 years are great. And then you'll have like a break even year. And you'll have like 2 more great years. But there'll be like 2 or 3 like break even or like subpar years in there. Like that happens. We can't expect everything to be super crazy every single year. But are you set up in your trading, in the business side of your trading? Are you set up to absorb that? Are you set up to kind of counter that with other pairs and or other strategies? So that's what makes the biggest difference. Yes, it is my only strategy, single pair, single time frame. Yeah. So that's the problem if you're going to do single pair, single time frame, right? Single pair, single time frame, meaning you're trading one pair, one strategy. Sorry, I'm having a little neck spasm here if you hear me kind of cringing. If you trade one pair, one strategy, you are all in. Right? This is the casino. You've pushed all your chips in. You're live or die, right? By that one thing. So if that one thing does great, guess what? You do great. If that one thing does poorly, guess what? You do poorly. You have nothing to kind of hedge your bets. So you're going to be in that situation where you're high risk, high reward. This is why we always talk about the importance of setting up a portfolio, right? Setting up a team. Think about it like tug of war, right? I was thinking about Squid Game the other day, and I was thinking about tug of war to death. For now, don't question me, right? But think about tug of war. If you got an 8-person team and one person slips, well, you got 7 people still carrying the weight. So you may give up a little bit of momentum, right? Because you're going to be stronger with 8 than 7, but you should still be able to survive. If your tug of war team is just you, one person, and you slip, you're done. Does that make sense, guys? Now, you've heard me talk before about you can trade one pair. We have a member here, a long-term member, good friend of mine, Tony, who for the longest time only traded a single pair. He only traded the pound yen. And everyone was like, well, how can you just trade one pair? Well, first of all, he's really good at trading that pair. But he traded a single pair with multiple strategies. So that's always the balance for me that I would say you want to have in your trading. The less pairs you trade, probably the more strategies or techniques. I don't even like the word strategy, but the more tactics you should have to trade that pair. The more pairs you trade, probably the less strategies, tactics, techniques you should use to trade, just because you don't want to get overwhelmed. But there should be kind of a set amount of ways to trade. So let's say there are 10 opportunities to trade. That's a big number. Let's say there's 5 opportunities to trade. That could mean you trade a single pair, but you can trade it 5 different ways. Or maybe you trade one way, but you do it on 5 different pairs. So I would continue testing first and foremost. Again, 2 years of data or 3 years of data isn't enough to panic. It's not enough to get excited over. You're going to need a lot more, a bigger sample size, so you get a full picture. And then eventually, again, and I don't know if you plan on adding more pairs or not, but I would certainly investigate trading more pairs, at least another one, to kind of hedge it and kind of give yourself more of a diverse portfolio. That way you can absorb if a single pair has a bad month, bad week, bad year. That makes sense. And if you trade multiple strategies on one pair, wouldn't the drawdown increase? Drawdown increase? No, the drawdown would decrease. Well, unless all of your strategies are hitting if all of your strategies are doing bad, then yes, your drawdown will increase. But theoretically, all of your strategies shouldn't be bad at the same time, right? I'll give you guys a good example. So I started off as mainly a counter trend and pattern trader. And this doesn't happen anymore, but historically, September used to be a month where I got lit up. Again, held up by the hair, had hair back then, and spanked and whipped and all the fun stuff, right? And because September was typically historically a directional month, very directional month, right? Where traders come off the summer, they get back in the market to see that, us retail traders kind of ruined everything and it's time to get back to business with some directional movement. So when you have directional trendy movement, you can imagine how bad it is for a counter trend trader, right? When levels of support and resistance aren't holding, they're just breaking left and right. So I historically in September got destroyed. So what I decided to do is, as a matter of fact, that was one of the main reasons I decided to start putting in more continuation and directional type of strategies into my portfolio, because now I can hedge myself. So I was still getting destroyed on my counter trend stuff in September, but I was now able to take advantage of the directional moves, which cut my drawdown in half, because I was losing money doing one strategy, but I was making money doing the other strategy. So I was more of a break-even trader than a losing trader. So if you have diversity in your strategies, unless they're all going bad at the same time, so unless you're adding stuff that is also bad, and that's why you want to, again, do your back testing, compare your results, see how they all look together. That equity curve will tell you a greater story than anything else in trading. I'll stand by that. All right. So unless you're doing that, and you shouldn't get to the point of live trading if you see those kind of warning signs in your equity curve, you should actually kind of hedge yourself and give yourself a little bit more safety. Now, at the same time, your spikes are going to decrease as well, because typically when the other strategy, like the continuation strategy, is going well, the other one may be doing poorly. So instead of like these massive like 20% booms in your equity curve, maybe you're down to 10%, which is still very good, but you get what I'm saying. It's not just, you can't just eliminate all the bad without hurting some of the good as well. But the idea is to have a smooth equity curve, not a spiky one that goes up and goes down. So, but like Orsi said, Orsi asked, is this based off live trading or back testing? But yeah, it's amazing when you back test and you crunch the numbers. There is no better, and if someone can give me one, I don't know. There is no better kind of projector of the future, right? I'm not saying it's a great projector of the future, but it's the best that we have. It's the best that we have. So it's like all the people that poo-poo on back testing because you're like, well, the past can't predict the future. Well, no crap. Like nothing can predict the future. Like that's a stupid statement, right? So if there's nothing that can predict the future, our best option is to find what we can that gives us the best chance of predicting the future. Like, like it's dumb. I hate when people make that argument because it's a dumb argument. Like you're giving an answer that doesn't exist, right? Unless you've created a time machine that can push me into the future and I can see stuff, nothing can predict the future. So why are you wasting your time saying that? You just do the best you can. Do the best you can. So good stuff. Says makes sense. It's based off back testing. I did 2019, 2020, 2021 was the break even year, about 400 trades total. Yep. Throw some more years in there. Toby says back testing. Hey, Toby, back testing puts the odds in your side. It's all about probabilities. Yeah. And it is. It is all about probabilities. And think about anything else that is predicted, right? Our economic stuff, our interest rate hikes, our chances of recession, Las Vegas and gambling odds, right? All it is predictable figures. It is probability. Is the casinos, right? Casinos don't know what hands they're going to win. They just know that if you play long enough, because they have the odds, they will win. It is strictly a numbers game, and all we're trying to do is make educated guesses. We never know for sure. We're just trying to make educated guesses. And when you have historical data to tell you that, hey, when this happens, this is likely to happen, or hey, historically, when these things do this, that thing does that, well, you're in a much better position to make those educated guesses than just flying blind. So good stuff. All right, YouTubers, trading viewers, I'm going to kick you off the live stream. I highly doubt I'm going to have a Trading Edge video for you this weekend. I've got a very busy weekend along with solo dad duty. So I have no idea how I'm going to handle all that. But I can basically tell you that you're not going to, well, unless I do it Sunday morning. Maybe I will. We'll see what type of mood I am. We'll see what the markets look like. If the markets are crap, then. But thank you for checking it out. As always, hit that like button on your way out. Show me some love. If you have any questions, leave them in the comment section below or reach out to me on social media. Live rumors. Where would you like to head to next? I got pound dollar. I got pound yen. I got euro Aussie, pound Aussie, euro New Zealand, and pound Canada all on my radar for today. Any of those interesting?